If Warren Buffett could pass down only one sentence to every investor on earth, it would be this: Rule number 1, never lose money. It sounds simple, but in reality, most people still lose money, sometimes a lot. Not because they're stupid, not because they're unlucky, but because they never understood what Buffett really meant. When Buffett says never lose money, he's not talking about avoiding red days or temporary drops on your screen. Staying calm through volatility is normal. Buffett actually loves when the market goes down because he gets to buy more. What he really means is this: never allow a permanent loss. Never put yourself in a position where your money disappears forever with no chance of recovery. And this is exactly where most investors fail. They have no idea what they're buying. They buy excitement, they buy hype, they buy whatever their friend mentioned at a weekend barbecue. Buffett, on the other hand, buys real businesses with real cash flow, real history, and real futures. Businesses he'd hold even if the stock market closed for 10 years. The funny part is that Buffett once made the same mistakes everyone else does. In 1942, 11-year-old Warren took all the money he had, $14.75, and bought 3 shares of City Service Preferred. He did everything wrong. He checked the price constantly, panicked when the stock dipped, and sold too early. But that one mistake taught him something most investors never learn. He had been trying to predict price movements, not understand the business he owned. Years later, at age 19, he read The Intelligent Investor, and his entire mindset changed. From that moment forward, he stopped buying stocks and started buying companies. That was the moment Warren Buffett truly became Warren Buffett. The truth is, most people don't lose money because the market is bad. They lose money because their emotions are bad. Buffett once said, if you're emotional about investments, you're not going to do well. He wasn't exaggerating. When emotions take over, you start confusing price with value. A $300 stock can be unbelievably cheap. A $3 stock can be dangerously overpriced. But most people only see numbers flashing on a screen. Buffett looks at the business behind the number. Another reason people go broke is borrowing money to invest. Buffett warns repeatedly that anything can happen in markets, and that's why he never borrows against his investments. Today, people take on margin, swipe credit cards, or take personal loans just to gamble on stocks they barely understand. When the market turns, they're forced to sell at the worst possible moment. That's a permanent loss, the exact loss Buffett refuses to take. There's also the problem of overtrading. Buffett once joked that students should be given a punch card with only 20 holes, each representing one investment they could make for their entire lives. If you only had 20 lifetime decisions, you'd never waste one on a random meme coin at 2 a.m. or a stock you heard about 5 minutes ago. Buffett calls today's hyperactive market the pickpocket of investors. The constant clicking and trading feels productive, but it's not. It's one of the fastest ways to destroy long-term wealth. So how do we actually follow rule number 1? Buffett relies on a simple 3-layer system. The first layer is your circle of competence. He never invests in things he doesn't understand, not even today. At the start of the 1900s, America had over 2,000 car companies. Almost all disappeared. Only 3 survived. Even if you knew the automobile would change the world, you still could have lost everything by picking the wrong company. Today, AI feels the same. Everyone knows it's changing the world. But choosing the winners is incredibly hard unless you're an expert in that field. The second layer is the margin of safety. Buffett uses a powerful analogy. If your truck weighs 9,800 pounds and the bridge limit is 10,000 pounds, you might risk it if the drop below is just a small creek. But if the bridge is hanging over the Grand Canyon, you want a massive margin of safety. Investing works the same way. Stable, defensive companies need less margin. High-risk, high-hype companies need a huge margin. If there's no gap between price and value, you're driving across a broken bridge. The final layer, and the hardest, is being comfortable doing nothing. In a world full of notifications, breaking news, stock alerts, and social media FOMO, staying still feels irresponsible. But Buffett understands something most investors have to learn the hard way. There are no called strikes in investing. You can stand there and let 1,000 pitches go by. Nobody penalizes you. You only swing when the right pitch finally comes, when the opportunity falls in your sweet spot. And that discipline is exactly why he wins. Rule number 1 exists not because the market is dangerous, but because human behavior is dangerous. We're impatient. We're emotional. We want to get rich fast. Buffett is the opposite. He doesn't try to be a genius. He doesn't try to predict the unpredictable. He simply protects his capital so that compound interest can quietly do all the heavy lifting. If there's one message you take away from this, let it be this. Most people go broke because they chase excitement. Buffett became wealthy because he chased clarity. He doesn't try to win every game. He just avoids the games that can wipe him out forever. And that mindset, the mindset that protects the downside so the upside can take care of itself, is the real meaning behind rule number 1. When you understand this, you don't just invest better, you think more clearly, you sleep more peacefully, and you build the kind of wealth that time, crisis, and market noise can never take away.